Hello and welcome to Exchanges for the third season. It's a pleasure to come back for a third season, and thank you to all of you that have been listening and watching over the season so far. We are starting with a bang today. The RBA. Where are they looking, thinking, and understanding the Australian economy is now and into the future? What do they think around inflation, and how are they going to look at the movements around productivity and growth, but also the neutral cash rate in the coming years ahead? Well, with that, Chief Economist Sarah Hunter is joining us on Exchanges this week to run through everything the RBA is seeing, doing, and looking to over the coming years. So without any further ado, here's the Exchange with Sarah Hunter. Sarah Hunter, welcome to Exchanges. I need to start first and foremost with the question you guys get asked almost every single meeting and almost at every Senate inquiry. How are you viewing the transition in inflation back to the target range that you have?
Yeah, thanks, Evan. And it's a real pleasure to be here with you today. Thank you for having me on the show. And it's obviously the question that's been occupying our minds here at the Reserve Bank, for the last few years, really. Um, Generally speaking, touch wood, we think the transition is going pretty well. We've now managed to get inflation down from almost 8%, where it was at the end of 2022. We're now coming in and inside the target band for trim mean, that's underlying inflation. So that's what we look at to cut out all the noise and the things that are volatile and can jump up and down. And so now we've managed to get that back down to under 3%. So we're inside our 2 to 3% target. So really the job from here for us is that we want to get it to the midpoint of that target. We don't want to be sort of skirting the top, because that means we could pop out and that wouldn't be great. Equally don't want to be skirting the bottom of the band, because then we might risk dropping out the other side, and that's also not good. So we want to try and keep it in the middle, around 2.5%. But really that's the job from here on, is what do we have to do to the cash rate policy settings to try and keep inflation where we are, and keep the economy on a steady heel.
So on that, some of the things that sort of talking about that sort of skirting to the top and the bottom that people are pointing out, services inflation is one that clearly is, touching the top of the band and obviously takes longer to get through. Whereas at the bottom, goods inflation and things like that is at the bottom. What of those two are occupying your minds more? Because services, as I said, takes longer and is a broader part of the Australian economy. Is that where you're sort of leaning to at the moment?
Yeah, no, and it's a really good question, and you can sort of think of it in two ways, actually. If you sort of take a long history of looking at inflation data, which I do, and I get into absolutely into the weeds, what you'll see is that it's not uncommon in history for different goods to have different inflation rates. So very, very rare. In fact, I don't think we've ever experienced this, where every single part of the CPI, every single goods and service, has been increasing at 2.5%. It just doesn't happen. It's pretty common for goods in general to have a lower inflation rate than services, and there's lots of reasons for that. We benefit from being an small open economy. We get globalization flowing through, and productivity improvements that push down on the price of goods in particular. And you tend to see less of that on the services side. So in and of itself, I'm not too worried if I see goods running a bit slower and services running a bit stronger, because that's what we've normally seen in history. Having said that, you're right, there are components of the CPI that we're paying close attention to at the moment, because we really just want to make sure we stick the landing, right? We don't want to have inflation popping back up. And what we've been focused on just recently, just looking at the data, has been housing services. So that's rent, but also the cost of new dwelling construction, which is actually a mix of services and goods. And we're also, as you mentioned, paying pretty close attention to market services. And a couple of reasons for that. One, as you said, it's a pretty big chunk of the basket overall if you put them all together. And also, two, it's one of the parts of the CPI that's particularly influenced by domestic factors. So that's where obviously we're having most impact when we're setting the cash rate. So we're looking at both of those two. They have been coming down, and that's good, and that's what we want to see. We just want to make sure that continues. And in the very latest monthly data, the last couple of months, we did see some signs that some of those components have perhaps been a bit stronger than we were expecting. And so that's a watch point for us right now.
Yeah, so can I go back then to the housing data, particularly the rental data? So the latest data from Cotality and also from PropTrack is that rental is now running at about 4.1, and it's ticking up quite neatly in terms of that, rental increase in pricing. How concerned are you about that, but also the fact that over the next 2 years, as your governor points out very clearly, Michelle Bullock, with the supply side taking at least 2 years to actually hit the numbers, does rent get slightly out of hand over the coming 24 months?
Yeah, so it's a good question. It's definitely a watch area for us. So we're paying very close attention to it. And so what we were expecting was that we would see sort of rental inflation perhaps sort of soften a little bit further from here, not too much, but really hold. And so we weren't expecting rental inflation to be one of those categories that would be running below 2.5%. And that's for all those reasons I was talking about earlier on. And in terms of that supply response for housing and that taking time, yeah, I mean, what the governor was really talking about was very basically, if you're trying to build an apartment block as a developer, by the time you've gone through the process of getting an approval and getting all your building construction work in place and your actual builder doing the work, I mean, it takes time to build a big block of flats, and then getting the final dwellings to market. That just takes years, right? I think we can all empathize with that. So she was really just making a comment about that and the time that it takes to get stuff done. So we are watching it. I mean, we were expecting it to take a bit of time for dwelling investment to really pick up. That's in our forecasts already, that you can see. And so we factor that in when we think about rents and things. From here, it's just a question of monitoring that, seeing what actually happens in terms of the response and around dwelling construction, and then what that flows through into the rental market. But yeah, look, all of these things are watch points for us. And it would be fantastic if we could see a stronger housing supply response. I mean, as the governor said, most people want to see that. Most people want to try and tackle affordability, but it does take a bit of time. We've been expecting that. We've known that. We've seen that before, so we won't be surprised if we see it again this time round.
Other thing that's also inside the inflation data that is quite closely monitored, labor unit costs are certainly still, above trend in terms of where they are. And yes, also we've seen the unemployment rate start to tick up, but overall, historically, it's still pretty tight in terms of where the employment market is. Do you see the wage growth scenario still also putting yourself at the top end of the band rather than the bottom end, with the way that the employment market is playing out and the fact that, unit labor costs still remain probably above historical trends as well?
Yeah, it's a really good question. We talk a lot about the labor market and what's happening in the labor market, and wages is obviously part of that. Because it's a really crucial key part of the economy. You know, pretty much everything that we consume, every good, every service that gets made in the economy involves the use of people. So jobs are everywhere. So that's why we pay such close attention to the labor market, because it gives us a really good read on what's happening across the whole economy, across all regions and sectors. And so the big question for us that relates to what you've asked is, what is full employment,
Mm.
and how close are we to full employment? We think that the labour market is still a little bit tight. We can still see some pockets. It's different in different sectors, in different regions. So I travel around the country, and I meet businesses as part of our liaison program, and I meet industry groups and what have you. When I go up to, say, Queensland, or if I go over to Adelaide, I get told there it's still a pretty tight market for construction. There's a lot of work going on, and they're still perhaps struggling a bit to get the labour that they need, just as one example of where we think the labour market's a bit tight. If you go to other parts of the country, though, it does look a bit softer, a bit looser, particularly down in Victoria. And actually, just you mentioned the unemployment rate. We can even see that in the aggregate data that we track. The unemployment rate in Victoria is a bit higher than it is in other parts of the country. So it's always good to cross reference and check the information that you're getting and see if it's consistent. So really what we're trying to do at the moment, still with policy, is get the economy to a point where we're at full employment. If we can get there, then those inflationary pressures that you talked about on the cost side, what we expect to happen is that they will sort of return to normal. So return to what would be consistent with inflation at around 2.5% in aggregate. And we're still just going through the back end of that process. I said we're pretty close, we hope, touch wood, but we're not quite there yet. So it is broadly about keeping us where we are today, but we've just got to make sure we get the job finished. And tracking those cost pressures is one of those things. So we just want to see them come off a little bit more, and then we'll be even more reassured that for at least in terms of the COVID surge of inflation, perhaps we're definitely past it. But We think we're getting close.
So then the future question comes into it. The last time that you and I met was in August with
Um,
regards to the last meeting. And you are talking now about what happens in November, the fact that we go from the quarterly data into finally having monthly data that has the full suite of the basket inside it. Take us through first, the work that you and your team have done over the last couple of years to get us to that point, but also how the RBA is going to transition over probably an 18 to 24-month period using the monthly data as your core data rather than sitting at the moment with the quarterly figures you're using.
Yeah, look, thank you for the question. This is so exciting. I mean, this isn't just once in a lifetime. This is once ever.
Yes.
So for the team that are working on this, I mean, this is a really great thing for them to do. Look, lots for them to be doing as well. As you said, we have put a lot of work in, and with our ABS colleagues, colleagues in Treasury, and so on. And we're very, very grateful, particularly to our ABS colleagues for making this happen for us. It is a massive step forward. It will be fantastic to get full monthly data, so we get 12 reads a year, not 4 reads a year of what's happening. But as you said, there is going to be a bit of a transition. So what will happen come the late November? It will be the first release for the month of October. So what the ABS are going to put out at that point is, as you said, that full monthly release. So we'll get a full read of what we call not seasonally adjusted data. So this is the data where they just tell you what the price level was in any given month, and they don't smooth through any of the regular seasonal events. So Boxing Day sales, for example.
Yeah.
Black Friday is actually a better example.
Yeah, I was going to
End
ask
of
about that because
financial year
obviously
stuff.
that's now spread
Yeah,
out, right? So
yeah,
October through
exactly.
December is no longer like it used to be because of those things.
Completely, and it's really interesting you say that because with the not seasonally adjusted data, you can just sort of pick it up and plug it in, and there it is. But really, what we want to do is smooth through those sorts of things. I don't really want to be looking at a drop in prices because it's Black Friday and thinking that's something that's fundamental, real, right? It's not. It's it happens every year. And so one of the challenges for the ABS with the monthly series is getting a complete picture of what those seasonal patterns are for everything that's in the CPI. So some stuff, yeah, your televisions and whatever, we know about Black Friday. Other stuff, though, it's a bit harder to get a handle on the seasonal pattern services, for instance. There are seasonal patterns in those series too, but they're not quite as regular. They might shift around given the timing of school holidays and things like that. And so, what the transition period is going to involve is the ABS are going to keep on gathering the data, and they're going to learn what the seasonal pattern is for everything. They know some of the seasonal patterns already. In fact, they know most, but not all of them. They're going to learn what those seasonal patterns are. And for us here at the bank, we're going to be learning too with them, with everyone else. But just whilst we're learning, we're going to keep focusing on and keep looking at that quarterly trim mean series because we know what the seasonal patterns in that are. We've had that for a long, long time now. It's very reliable. For us, it's the series that we use to give an indicator or a lead, if you like, on what's going to happen to headline CPI. That's why we focus on it. And just through that transition, we're going to keep looking at that quarterly series as well as taking in the new information from the monthly. So it's only an improvement. We're not going to ignore the new monthly completely. Far, far from it. We're going to make full use of it. And over time, we'll get to a point where, the seasonal patterns will be bedded down. We'll understand it, us here at the bank and everyone else. And then we can make that final transition. But as you say, it is going to be sort of 18 months to 2 years before the ABS are ready to do that. And that's why they're going to keep publishing that quarterly trim mean through to mid 2027-ish at the very least.
So I'm going to throw in a little bit of a different one for you there as well. You talked about learning and about how you're going to start applying that. Are you using AI to help you with that modeling?
Yeah, good question. And I should say, like, one of the absolute joys and pleasures of my job is I work with a team who are curious and are constantly wanting to learn. We want to improve our understanding of the economy. It's what means that we can do our job better. So we're always looking at new ways, new techniques, new data sources. And we're so lucky at the moment. I think over my career, the amount of data that we have now compared to when I started, it's like night and day. It's just fantastic. And as you say, tools like AI are one of the things that we can use to really dig into that data and assess it in a different way. And so the short answer to your question is we already use AI actually to help us with our analysis. So people may know we have our liaison program. We do about 900 or so interviews a year with institutions, businesses, not-for-profits, some government departments, a whole range of different operators in the economy over a year. And up until recently, we were sort of writing down what people were saying, and we had qualitative information, which was super useful, but it wasn't really anything you could plug into a model.
Uh-huh.
Now we've got a large language model that we've developed internally, and we use it to effectively extract information from those liaison notes that we have and turn them into quantitative series. So we have a range of different indices that tell us what's happening, how people feel about their forward orders compared to activity today, what they expect to do to their prices in the future compared to today, and so on and so on. And we are now starting to use some of those series in our models. So the short answer is yes, we will continue to do more of it, experiment with it and play with it. But it's already helping. So I think it's the kind of technology, if you can figure out how to harness it, it will definitely improve how you work.
So that's my flow on to the next pivot. So we're going to move slightly away from inflation and talking about that, because the next one to therefore discuss, which the RBA is clearly doing a lot of research around, is productivity. And I do want to read this statement that you had in your fourth part of your statement on monetary policy that really caught my attention when I saw this, which was, we've revised down aggregate demand in line with potential output. The lower assumption for trend productivity growth in the future has not changed, but our assessment of the current and future balance between supply capacity and demand, and therefore inflationary pressure. This reflects an assumption that businesses and consumers have already adjusted to a lower productivity growth environment, and they expect lower growth in productivity, incomes, and revenues to persist over the forecast period. So this question is what everybody's debating at the moment. We had an economic roundtable around this, etc. We know that productivity in Australia is at a level that is at decade lows. First and foremost, can I get you to define how you look at productivity? Because I think the word productivity is seen as do more with less. It's not that. But also the fact that we are now, as your statement puts out there, that unfortunately we are starting to accept lower productivity as trend, and how we can possibly break out of it.
Yeah, no, it's a great question. And you're absolutely right. The word productivity means different things to different people. So I'll just gonna, yeah, we use a really sort of technical macroeconomist definition here at the bank, as you might expect.
Yes.
For us, productivity or productivity growth means that for the same amount of input, so that's the workers in businesses, the capital that they might have, that's everything from factories to laptops to infrastructure, everything else, your education, everything that you have that goes into making stuff, you're able to make a little bit more for the same amount of input. And so I suppose my AI example from earlier is perhaps a really good one. By making use of AI technology, we're now able to free up some time for economists that used to be doing that manual processing themselves, and they can do other work.
Mhm.
So, and other higher value work as well. You know, manual processing of data is pretty time intensive, and you don't get much back from it. It's the analysis that you do with it that really counts. So that's for us at the bank. That's what productivity growth looks like. But in different organizations, it's going to look different. It's giving people, if run a factory, you put in the latest machinery and equipment in your space, and that means that you can, for your same number of workers, you can just increase the amount of products that you make, or what have you. So that's how we define productivity and productivity growth. In terms of how we look at it and why we look at it and what kind of forecast horizon are we looking over? And yeah, look, we're observing the same data as everybody else, and it's you can see it in the statistics that productivity growth has slowed generally in all countries over the last 2 decades or so. There is an exception across advanced economies, which is the US, and it is an exceptional performance there just recently. But setting them to one side, generally most advanced economies have seen this, so we're not alone in this experience. And it just means that those incremental improvements I was talking about, the pace of those incremental improvements has slowed down. We've been observing it. We thought that, particularly with COVID was so disruptive, we weren't quite sure what was happening to that underlying trend for a little while. We've now got to a point where we think actually some of what we thought might be unwound and was related to COVID and COVID disruption, it actually looks like it's a bit more sticky, if you like, or it's a bit more structural. And that's really what we're reflecting in that productivity growth assumption downgrade. So in a way, you can think of it as us catching up with what has actually been happening on the ground.
Mhm.
And the reason we've had to catch up is because for a while, what we were seeing in the data was so noisy and messy with COVID, we just weren't quite sure what was structural and what was sort of related to that disruption that then naturally went away. So we've caught up, if you like, with what's been happening, and that's why we don't expect there to be any fundamental changes in how people make the decisions that they make as a result of this. This is us catching up with everyone else, not everyone else moving to us. And so that's why we've not really changed our view of the balance of demand and supply in the economy right now as a result of this assumption, and why we've effectively just passed it through into our GDP outlook going forward. So that those things have, yes, the GDP growth forecast has been downgraded, but the fundamentals in terms of inflation haven't really changed. The final point I'll make on this is that just to stress, our forecast horizon is only a couple of years, 2.5 years. We run through to the end of 27 at the moment, because that's the horizon that monetary policy really has an impact on the economy. That's why we focus it. It's really quite short term, particularly in productivity world. So productivity, if you do anything to change productivity, I'm sure some of your listeners can empathize with this. If you install some new machinery and equipment, or you put some training into your workforce, you have to wait time for that to really start to manifest. Same thing for any changes that government might make to regulations or other policies. They just take time. So we're going to keep looking at this. We'll come back and we'll talk about it again over time as we move forward. But we're not really saying anything about the next 10 years, 20 years, 30 years. We're just really focused on that short-term horizon.
So I'm going to go back to the AI question then again, is that the word you're basically using there is enhancement, right? So enhancing your workforce by freeing up, human capital to do the more advanced information, etc. Is AI that technology input that can start to free up not just the productivity that will take time, but the productivity that'll happen now? Because that's the argument it's presenting. Do you guys at the board see that also being the case?
Yeah, well, I think the answer to that is potentially, all right?
Yeah.
I certainly don't have any crystal ball on this one, and I'm not an AI expert. And so maybe, and that's the thing that we're all going to learn. I think if I look back through history and think about generalist technologies like this, so AI is a technology you can imagine using in pretty much any job in any sector, as opposed to an improvement that might be quite sector specific, like a new medical device or something like that. It's not going to help me in my job, but great for doctors using it. But if you think about generalist technologies like this, the history shows you that previous sort of waves of this kind of thing, if that's electrification or if that's the establishment of the factory production line that happened in the late 1800s, early 1900s, and things like this, they take a long time to filter all the way through because we've all got to work out how to use them. And really, when I say work out how to use them, it's not usually the first version of using the technology that really gets you the advances. It'll be the second and the third wave where we really figure out, oh wow, it can really take on a lot of tasks that we previously had to do ourselves, and that really frees up our time. So I don't know is the answer. That's the question, right? We're going to be
Mhm.
monitoring it. I think we're all going to find out over the next 3, 5, 10 years, and even beyond that. And let's watch this space and wait and see. I think some tasks that we do, I think most people can already see you could use AI to do them instead, and which is great. But I'm interested in what tasks that we haven't even tried to use AI for yet, and how transformative it might be in those spaces.
That therefore pivots nicely to the final thing to then discuss is growth, which is the Australian economy is, growing below historical trends, but certainly moving in the right direction. There are signs, very small signs, but there are signs that the pivot from public to private numbers is starting to happen. What are your views for 2026 and 2027, which is your 2-year time frame that you
Mhm.
forecast through, with monetary policy still, in your view, slightly restrictive, not as restrictive as it was. Public fiscal policy still quite open in terms of what it's doing. Where does the Australian growth profile sit for the next 2 years?
Mm. Yeah, no, it's a great question. Obviously, it's something that we really, really focus on. So I suppose maybe a couple of points just to frame it. One, in terms of what do we think now is a sustainable pace of growth of the economy, or a
Mhm.
pace of growth we think the economy can achieve without generating inflationary pressures. And this is over that 1, 2 year horizon, not in any given quarter. Things can be volatile from month to month. Well, we think that pace now is around about 2%. So that's that 0.7% productivity growth is one chunk of that. And the rest of it, around about 1.3, 1.4%, is what we think the population growth is going to be. I should say, actually, we use Treasury's Centre for Population Studies population forecast to in our forecast. So that number really just comes from them. And you more or less add the two together, roughly speaking, and you come up with around 2%. So that's where that number comes from. And that's what we think the pace is that we can, say, sustain on an ongoing basis without generating inflationary pressures. And so over the next few quarters, we think the economy is sort of going to get to that pace there or thereabouts. And then we think it's going to stay there. If you look in the August S&P forecast, you'll see in the forecast table that there's lots of low twos for GDP growth over the next couple of years. And that's consistent with what I've just said. So we think we're going to get back to full employment. We hope that we're going to get inflation back around the middle of the band. And then we're trying to set policy to kind of keep it there and keep the economy ticking over, if you like, at that trend pace of growth. In terms of the composition of demand, you're right. We've been watching for some time and expecting for some time that the private sector momentum would pick up a bit. We could see in the government budgets that the momentum on the government spending side was going to soften. So thinking about, say, government investment, it's not that it's necessarily going to fall, but it's just not going to keep growing as quickly as it has. And so we've been expecting that. As you said, we're starting to see that. So some of the headwinds that households are facing, we think are easing. We know it's still pretty tough for some people. And we know the cost of living is still a challenge, right? The prices are higher and that's uncomfortable. But the good news for households is that on average, wages are now growing faster than inflation. So people are getting real wage gains, which is obviously really helpful to see. We've still got some of the impacts of the tax cuts that were fed through last year are still coming through as well and helping to support incomes. And we've still got, as you said, in the labour market, we think it's pretty close to full employment. So more people working proportionally than we've had in the past. And that's really good for household income too. So households, we think, are starting to lift their consumption, and that's helping to support growth. And we do think that dwelling investment is also going to pick up. We talked about it earlier. It does take time. But the start of the cycle isn't today. It's a bit earlier in the piece. And so we're starting to see a bit of a pickup there. And we know that cash rate cuts, interest rate cuts are particularly impactful in that housing sector. So there is that transition going on, and we think there's a bit more of that to run. But really, over the next sort of 6 months or so, perhaps we'll be getting back to around about the pace of trend growth. And what we're trying to do is keep us there, because we also think we'll be back at that pace where at a time where we're at around about full employment, which will be great. And we hope that we'll also have inflation around about the midpoint of the target band. And so the trick for policy now, the board, the decision they're making every time is, what do we need to do to the cash rate to keep that there, to make sure that we've got enough demand in the system, if you like, that we can keep up with supply, but we don't want to overcook it. We don't want to have demand running too strong because that will generate inflation. Equally, we don't want to have demand running too weak because then we'll undercook it and we'll have inflation falling through the bottom of the target band. So it's a balancing act, I suppose, now. And that's the job.
So there's so much to unpack there. So first and foremost, I just want to go right back to what you said around, now accepting that sort of, that equilibrium point is 2%. So Australians have long believed that actually the equilibrium point in the 80s, 90s, and probably early 2000s is more 2.5% to 3%. Do you think that A, we haven't accepted that, and B, can that also explain why in the consumer confidence surveys, etc., that we remain pessimistic, that although growth is happening, we don't believe it's happening at a rate that it should be. We don't feel like we're getting the kinds of returns that we probably once upon a did in the previous decades. Does that all filter into how you view that now? Is that we need to accept we're not just a developed economy, but we're actually a mature economy that can't grow at the same rate that we used to? But also that pessimism we're feeling is the transition away from a slightly higher growth economy into a more middle of the road growth economy.
Yeah, it's a really good question. I mean, economies change and adapt and evolve all the time, in every country in the world goes through this. Australia's not alone. And so, there is some sense of this is our assessment right now, and we do think it's a lower pace than in the past. It doesn't have to be in the future. Let's see. As I said, we're really focused on that 2-year horizon. So, this isn't us saying that, well, this is it forevermore. But just, at the moment, this is what we think it is. And you're right, it is a bit slower pace of growth than we've seen in the past, partly because population growth is a little bit slower than it was, and particularly in the 80s and the 90s, and partly because productivity growth is a bit slower than it was back then as well. And so, we put our view out there, and yeah, let's see what happens. I should also say it is our assessment, but we are very conscious that we could be wrong on this. We're very mindful of how we could be wrong. We could be wrong on both sides, as I said. So we'll be looking at the data very carefully to see what plays out. In terms of consumer confidence, that's a really interesting question. I have to say, we're not 100% sure why consumer confidence is still as low as it is. It's, as you said, it still generally depends on which metric you look at, but all of them pretty much are sitting below their long run historical averages. We think maybe part of that might be the cost of living and the shift up in the cost of living or the price level. So it's just taking us all a bit of time to get used to that shift up in that price level. Uh, but that possibly isn't explaining everything, though. And the other really interesting feature is that this sort of subdued level of consumer confidence relative to historical averages is actually a common experience across most advanced economies. Again, we're not alone in this either. If you look at some of the American series, for instance, they're also pretty depressed. You can see that across some of the European countries too. So it feels like there's a common global aspect to this as well, which we haven't quite put our finger on. And maybe that's a cost of living point that I just made, or maybe it's something else. So I don't entirely have the answer for you. And is really interesting to observe. It's interesting to see that confidence has picked up a bit this year, but perhaps hasn't quite got to the levels you would expect, given what's happened to spending. That historical relationship is perhaps shifted a bit, and I think it'll just be we'll have to just see how it plays out. We'll be learning along with everybody else, but I don't rightly have an answer for you. We have dug into it. We've got partial answers, but we haven't got a complete answer.
So then the final part of that debate question is rates. I mean, I haven't deliberately asked you about where the cash rate is. You've taken 3 rate cuts out of in this current rate cycle. Your own forecasts suggest that you've still got a few more to come over the coming 12 months. What are you getting close to what you believe is non-restrictive, but obviously almost equilibrium point? And do you feel that you've got enough data to feel confident that your current forecasts of cutting rates a couple more times before you finish here is where you're gonna get to, or do you believe with what we've just discussed over the last half an hour may sort of hold your hand as we wait to see that data really filter through in a bit more detail?
Yeah, it's a great question, and so as you've alluded to, our forecasts, whenever we do them, and the latest ones that we have are from August at the moment. We have to build them on an assumption for the cash rate because we know it matters clearly, and so we take the market path as that assumption. So what the markets expect, just ahead of the August meeting, was the setting assumption, if you like, for our forecasts. And so really the job from here for us is assessing how things are actually playing out relative to our forecasts. And then obviously we advise the board on what that might mean in terms of the direction for policy and any future cash rate cuts or not or what. And so I certainly can't guarantee that the August forecasts are going to come through. In fact, I'd say the opposite. The one thing I can guarantee is that they won't exactly come through as we had them there. I'm a forecaster. I've many, many more misses than hits in my career, and that's entirely typical. And what we've seen in the latest data, actually, if anything, is come through a touch stronger than we were expecting in August. So we got the national accounts data for the June quarter this year. They were a touch stronger. Consumption that we talked about earlier certainly came through stronger, and overall GDP growth. We've also had a couple of monthly inflation prints. They've been a touch stronger. On the other side, though, we've had a slowdown in employment growth, and that's, if anything, a little bit weaker than we were expecting. And we do still have a lot of uncertainty, particularly around the global outlook. There's new announcements around tariffs and trade settings still coming through at a fairly quick pace, and other developments as well. So we're weighing up all of these things at the moment. And in fact, it's only 3 weeks or so until our next board meeting, and our next set of forecasts will go out. So we're in the process now of updating the view, and we'll have a refresh, if you like, to say at that point in time. But In terms of restrictiveness and how we see that, a couple of comments I'd make there. I'm often asked, what do we think the neutral rate of interest for the economy is? What's the number? and
How long's a
and a
piece of
bit of
string, right?
well, exactly. And I won't repeat too much of that because I know we've said that in the past, but very, very hard to estimate is what I'll say to that. But more than that, actually, it's never the case that we're aiming for a specific number for the cash rate at any given point in time, because the neutral rate, when you estimate it with all of the uncertainties around that, what you're trying to extract is a long run fundamental measure for the economy, and you base it on decades of data. So we go, our models will run back into the 1990s. But at any given point in time, there's always a whole bunch of other things that are impacting the economy that you have to respond to when you set monetary policy. So that can be those international conditions that I just talked about. It can be a shift in maybe consumer confidence, and that's responding a bit differently. So that's something that we've seen that's not been seen in the past. We are obviously take into account what government spending is doing, and business investment tensions. All of those things come together, and the board are really setting the interest rate to take all of those things to account. So it's really not a question of what's the number and how quickly do we get there. Far, far from it. It really is a question of what's the right setting for the cash rate today, given everything that's going on in the economy. So I'd always caution people to not look at whatever they think their estimate of neutral is and just sort of mechanically say, oh, well, that's where the cash rate's going to go for sure, because that's really not how it works. It's a long run concept that gives you a bit of a guide and to whether or not you're being restrictive and how much, but it's just that.
Sarah Hunter, we've run out of time. I can't believe it's been an incredible conversation. So I'm going to finish as I do with every single guest I have on Exchanges. Sarah Hunter, if you're in charge for just one day, what would you do?
Oh, goodness. Such a good question. So, I don't know if I'm in charge of my own family or my neighborhood or the whole world here, but I feel like we move really quickly. I think the news cycle moves really fast at the moment. There's things coming at us all the time, and we're all feeling like we're rushed off our feet. Everyone tells that, and I certainly feel that myself. I would love to give us all a bit of a breath and a pause, so that we can pause and take stock and really just sort of think about the fundamentals. And perhaps I'm trying to tell myself to stay away from the news, X, and other social media for at least an hour or two, so I can take a breath.
Yeah. Sarah Hunter, it's been an absolute pleasure. Thank you for joining Exchanges.
Thank you so much for having me.
Big thank you to Sarah Hunter for joining Exchange. It was an absolute pleasure to get one of the best minds in economics in this country on Exchanges. What an understanding, very open about what the RBA is seeing and doing. So big thank you to both Sarah and the RBA for her time coming on Exchanges. To you out there, thank you as always for watching, listening, or wherever it is that you're getting this Exchange podcast. We love having you as part of this incredible community, and thank you for watching enough that we've now got a season 3. If you do have any ideas, thoughts, or questions, don't forget we do have an email. It's exchanges@evanlucas.com.au. Until next week, thank you again for watching and listening. And this has been Exchanges.